right. So could there be something systemic here? Obviously, a lot of nervousness before the markets open on Monday. Wall Street skid more than 300 points yesterday. For all of Wall Street, the worst week of the year thus far, and it's been a bumpy year thus far. Let's go to Kenny Polcari on all of this, the Case Capital Advisors founder. We've also got Aaron Gibbs, the Main Street Asset Management CIO. Guys, welcome to both of you. We're learning in the last hour that the UK finance minister has spoken to the governor of the Bank of England over Silicon Valley and what happened there. Now, of course, Silicon Valley has no attachment to markets abroad that we know of. But again, there's a worry about this being maybe bigger than this being another Bear Stearns, that kind of thing, a Lehman Brothers. What do you think of that, Kenny?
So I don't think it's a Lehman moment or a Bear Stearns moment. I think Kevin O'Leary was exactly right. It was absolutely poor risk management at Silicon Valley Bank. They made a bet. They were clearly unaware of what was going on in the financial world. They were unaware clearly what was happening at the Treasury, at the Fed with rising rates. I mean, we've been talking about this for a year and a half. The Fed has been raising rates, slowly and gently for a year and a half. This is not something that just came out of left field. And, there's an accounting rule in the banking industry that, hold till maturity and not marking to market a portfolio of bonds. Had they done this, they would have realized, and it was actually brought to attention right after the earnings announcement in January, but it's interesting, no regulators, nobody seemed to pay attention, that had they been forced to market, they would have realized that they had a $15 billion loss on their hands. Actually, they probably realized it, but the world would have realized it, the regulators would have realized it, and maybe, just maybe, this could have been somewhat avoided. I don't think it was impossible, but the risk management team at Silicon Valley Bank, I think clearly, if you look at it, seemed to be very inexperienced in the financial world. And I wonder, Neil, if there was anyone that lived through 1975, 1982 that was somehow anywhere connected to this bank, because they, clearly it feels to me that nobody understood the implications.
The irony of this, though, and whatever you think of the bank, is it wasn't doing anything nefarious with mortgage derivatives or assets that were risky. It was investing in Treasury notes and bonds, which normally is the safest of the safe. Unfortunately, it bought the majority of those bonds, before interest rates started rocketing. So they were underwater when they needed to provide cash for a lot of investors who wanted out. We know the rest of the story. I guess the reason why I'm mentioning that to you is a lot of folks did that. And a lot of folks might have that type of position that, if they own those securities right through when they mature and are due, they're fine. If they don't, they're really technically underwater. Do you see that?
Right, and that's because absolutely, because that's the way you make money off of cash deposits. You find some sort of safe yield. And so you were looking for longer treasuries that had higher yields versus cash, which was essentially zero. And so we know that banks that might have runs on them, where they have very concentrated types of clients, where all their clients are going to need money at the same time, those are the banks that are at risk. Fortunately, we know that Wall Street has already identified those few banks, and obviously it's all about deposits. You do have to put your money somewhere, and so much like Kevin O'Leary said, if you've got all your cash spread across 5 different banks, we won't have those massive runs, because we're talking about actual cash, not loans like we did in the 2008 crisis. So it is very different in just how the banks manage those assets.
Right.
Though, Kenny, what's to stop people who have their money in a regional bank or mid-sized bank, whether there's anything wrong or even risky about that, but then say, well, maybe I need to be in one of these big money center banks because they're a lot less leverage, a lot spread out. They have a lot more diverse depositor base. So through no fault of the regional banks that were getting slammed in the last week, their customers wonder.
Well, listen, and you can't blame them, right? You can't blame the customers from being concerned about that. Now, if the regional banks are not in that space, are not under those demands that SIVB was, then I would say to anybody, there's not that risk. There's no reason to have that fear. But you can't stop somebody after what they're witnessing to want to be more protective. And to, like Kevin O'Leary, like Aaron just said, if you're spreading out your assets amongst, 3 or 4 different banks, then you're going to reduce your exposure. But I suspect that you're going to have some people that are going to do exactly what you suggested, and they're going to try to move their money, and that may cause some kind of uncertainty and some volatility in the days ahead. But again, I would say if the regional bank is not in that space, that tech space, that venture capital space, and doesn't have the risk that SIVB had, then I would say, you might be a little bit better off. But I would say also, you need to protect yourself if you feel uneasy at all. And there's nothing wrong with wanting to protect yourself and your asset at any, by any stretch.
Aaron, dumb question though this might be, and you've endured that over the years with me, but I'm wondering if you're Jerome Powell at the Federal Reserve and you have this concern about possibly this thing mushrooming beyond just, Silicon Valley. Do you slow down your interest rate increases?
I think at this point, the Fed is much more concerned about inflation. Certainly, if it obviously becomes more widespread, he could be concerned, but just the fact that it really is only about where you get bank runs and you ultimately do have to put your cash somewhere. It's not like we're suddenly going to send all of our cash outside of banks in the U.S. So I think that scenario would be extraordinarily unlikely. I don't think it's something that Powell would be looking at. It's really about the smaller banks where they have concentrated types of investors and where investors don't have their money spread across. So I don't see it happening, but certainly if it did, yes, of course he'd address it.
All right. Final word on that. Aaron, I want to thank you. Kenny, thank you. So we'll see what